Hey guys, welcome back to Flow State Finance. I'm Arnav, and today I'll be talking about the who and the what behind the numbers. I'll be discussing a typical accounting hierarchy, as well as going over a few important forms that public companies must file during the financial year. Let's get started.
Alright, so first, let's talk about the accounting hierarchy. Here's a diagram that shows a typical accounting hierarchy. On the top, you can see you have the Chief Financial Officer. Below them, you have the Treasurer and the Controller. Below the Controller is the Accounting Manager, then the Accountant/Analyst, and finally, you have the Clerk/Assistant. Let's go over each of these roles in detail. First is the Chief Financial Officer. The Chief Financial Officer is responsible for overseeing all financial matters within a company. They evaluate the major financial components of a company, including individual products, major revenue streams, or even entire departments. The Chief Financial Officer, or the CFO, focuses on the financial big picture, and they're usually part of the executive board, so they have tremendous influence in the company. Think of it like this: they are at the top of the financial food chain. Next, we have the Treasurer. Now, you may have noticed that the Treasurer was on the left side of the diagram, instead of on the right with the other roles, and that's because the Treasurer operates both within and outside of the company. The Treasurer is responsible for investor relations, banking relationships, cash flow management, and equity and capital structure decisions. Basically, they're the analytical head of external financial decisions. The Treasurer has a lot of influence on financial decisions outside of the company, most notably of which are the company's external investments. The Treasurer also either reports to the CFO or in some cases holds a seat on the executive board. Next, let's talk about the Controller. Sometimes this position is also known as the Comptroller, and their responsibility is to consolidate financial information into detailed reports. They ensure that day-to-day financial operations go smoothly, but unlike the CFO, the Controller focuses on the smaller details, and the Controller reports directly to the CFO. The accounting manager's job is to supervise individual and groups of accountants in a specific area. They prepare general financial reports, audits, ledgers, and budgets. And like the controller, the accounting manager focuses on the small details of financial operations going on within the company. They report to the controller and often meet with them to discuss special reports or notable financial events under their jurisdiction. Next, we have the accountant/analyst. The accountant is responsible for common day-to-day accounting tasks. In smaller companies, one or two individuals may do all of the above, but if we're looking at larger companies, a lot of these subsections are delegated to individual accountants. Accountants typically report to an accounting manager or, in some cases, the sole accounting manager. Finally, working directly under the accountants, we have the clerk or the assistant. Their job is to help accountants with their daily work. They handle many of the time-intensive tasks associated with accounting. So, for example, think data entry or filtering, things like that. Now, these positions are much more common in larger companies because in smaller ones, the accountants do all of this work by themselves. And as I mentioned before, they report directly to the accountants. Now that we've gone over a typical accounting hierarchy, let's discuss some of the accounting documentation that public companies must file during each financial year. The four key documents are the Form 10-K, the Form 10-Q, the Form 8-K, and the proxy statement. Let's go over each of these in detail. First, we have the Form 10-K. The Form 10-K is a detailed report on a company's performance over the last financial year. Now, an important thing to note about the term financial year is that financial year doesn't necessarily refer to January 1st to December 31st. That is the calendar year. A company's financial year can technically start at any point during the calendar year. So, for example, you might have a financial year that starts at January 31st and ends January 31st of the next year. Or you might have one that starts in October and ends in October of next year. So the financial year is independent of the calendar year. They're two different things. Now, let's talk more about the 10K. The 10K provides a lot of qualitative and quantitative information about the company. On the qualitative side, it talks about the business segment that the company operates within, as well as customers, competition, and any significant events that have taken place over the last financial year. On the quantitative side, it provides audited financial statements, MD&A, which stands for Management's Discussion and Analysis, debt details, and shares outstanding. Audited financial statements are financial statements that have been certified by a CPA or a certified public accountant as being authentic. MD&A, or management's discussion and analysis, is basically the executive's evaluation of how the company is doing. Debt details is exactly what it sounds like. It's a detailed summary of the company's debts. And finally, we have shares outstanding, which is the total number of shares owned by shareholders, investors, and employees of the company. Next, let's talk about the Form 10-Q. The 10-Q provides a detailed report on a company's performance over the last financial quarter. It's less comprehensive than the 10-K, but it still contains the MD&A, which remember stands for Management's Discussion and Analysis, for the last quarter, as well as the year to date. The 10-Q is important because it provides the most recent and accurate financial information for that particular point in time. So, for example, if you want to most accurately compare how the company was doing during the end of its second financial quarter with its status in the end of the third financial quarter, you would compare their two 10-Qs. Next, let's talk about the 8-K. The 8-K documents any material changes within the company that would be of importance to shareholders. So things like entry into a purchase or sale agreement, completion of an acquisition, bankruptcy, or the departure of a senior executive like a CEO, CFO, etc. Many companies put out earnings press releases in an 8-K near the end of the financial year in place of a formal 10-Q. So at the end of the financial year, instead of filing a formal 10-Q for that financial quarter, many companies will just incorporate that data into their 10-K for the year. But what a lot of investment bankers rely on is the earnings press release that they put out in an 8-K at the end of the financial year that gives accurate financial information for that specific quarter. It sort of acts like a 10-Q for the fourth financial quarter for some companies. And finally, let's discuss the proxy statement. The proxy statement is sent to shareholders before meetings to properly inform their decisions regarding the company's future. It's very comprehensive and it provides great financial insight into the company and its recent operations. Here's just a small list of the information it contains: the management profile and executive compensation, breakdown of insider equity ownership, notable business issues or points of discussion, and senior level loans. The management profile is the part of the proxy statement that gives details about each of the management employees in the company, and executive compensation tells shareholders just how much their executives are earning. Breakdown of insider equity ownership is a detailed summary of the stock that employees of the company own. Notable business issues or points of discussion are things that the company wants to discuss with its shareholders during the meeting. And finally, we have senior level loans. These are very important to discuss because what a lot of companies will do is lend out money to their senior level executives for much lower interest rates than those available on the market. It's important for shareholders to keep track of just how much money is being lent out to executives because a lot of times that money is never returned. If the company is handing out too many senior level loans, that's a big red flag because that's money that could be used to pay dividends to shareholders or be applied in other places throughout the company. But if it's being given to executives in the form of low interest rate loans, that could hint at a management issue in the company. And with that, we conclude today's presentation.
That's all for today. I hope you learned something new, and if you did, be sure to like, subscribe, and share this video with your friends. If you're interested in learning more about the rules and guidelines that accountants follow in doing their daily work, be sure to check out my video on GAAP. Thank you for learning with Flow State Finance.